Topic examines credit analysis for corporate issuers and explains how analysts evaluate a company's ability to meet its debt obligations. Corporate credit analysis is essential in fixed income investing because bondholders face the risk that issuers may fail to make scheduled interest or principal payments. Analysts assess both quantitative financial measures and qualitative business factors to determine the probability of default and expected recovery in the event of financial distress. Effective credit analysis supports investment decisions, pricing of corporate bonds, and risk management. Understanding corporate creditworthiness is therefore fundamental for evaluating fixed income securities and constructing diversified bond portfolios within global capital markets. Qualitative analysis plays a significant role in assessing a corporate issuer's credit quality. Analysts evaluate the company's business model, competitive position, industry dynamics, management quality, and corporate governance practices. Firms operating in stable industries with durable competitive advantages and diversified revenue sources generally exhibit lower credit risk. Management effectiveness is also important because strategic decisions regarding leverage, expansion, acquisitions, and liquidity management influence long-term financial stability. Industry conditions such as technological disruption, regulatory changes, or cyclical demand patterns may materially affect a company's earnings capacity and debt repayment ability. Consequently, qualitative analysis provides important context beyond financial statements when evaluating corporate creditworthiness. Quantitative analysis focuses on the issuer's financial performance and balance sheet strength. Analysts examine profitability, leverage, liquidity, and cash flow generation to assess the company's ability to service debt obligations. Key profitability measures include operating margin, return on assets, and return on equity, which indicate operational efficiency and earnings quality. Stable and predictable earnings generally support stronger credit profiles because they improve debt repayment capacity. Analysts also assess revenue growth trends and earnings volatility, particularly in cyclical industries where economic downturns may significantly weaken financial performance and increase the probability of default. Quantitative analysis therefore forms the foundation of corporate credit evaluation. Leverage analysis is central to evaluating financial risk within corporate credit analysis. Leverage ratios such as debt to equity, debt to assets, and debt to EBITDA measure the extent to which a company relies on borrowed funds. Higher leverage generally increases financial risk because larger debt obligations require consistent cash flows to support interest and principal payments. Analysts also evaluate the maturity structure of debt and refinancing needs, as excessive short-term obligations may create liquidity pressure. Companies with moderate leverage, stable earnings, and strong interest coverage ratios are typically viewed as lower-risk borrowers. Excessive leverage, by contrast, may reduce financial flexibility and heighten vulnerability during economic downturns. Liquidity and cash flow analysis are equally important in determining a firm's short-term financial resilience. Analysts examine current ratios, quick ratios, operating cash flow, and free cash flow to assess the issuer's ability to meet near-term obligations. Positive and stable operating cash flows support debt servicing capacity and reduce refinancing risk. Free cash flow, which represents cash remaining after capital expenditures, indicates the company's ability to repay debt, distribute dividends, or fund expansion without relying excessively on external financing. Weak liquidity positions or negative cash flow trends may signal potential financial distress, particularly during periods of economic contraction or reduced access to capital markets. The topic also discusses debt seniority and security provisions, which influence expected recovery rates in bankruptcy or restructuring scenarios. Senior secured debt has the highest claim on pledged assets and generally carries lower credit risk and lower yields. Unsecured bonds rely on the issuer's general creditworthiness and therefore involve greater default exposure. Subordinated debt ranks below senior obligations in repayment priority and typically offers higher yields to compensate investors for increased risk. Analysts carefully examine capital structure hierarchy, collateral arrangements, and covenant protections because these factors materially affect recovery prospects and expected losses if the issuer encounters financial difficulties or defaults on its obligations. Credit ratings assigned by agencies such as Moody's, Standard & Poor's, and Fitch provide standardized assessments of corporate credit quality. Investment-grade issuers generally exhibit strong repayment capacity and stable financial profiles, while high-yield issuers carry elevated default risk and greater earnings volatility. Analysts use ratings as reference points but also conduct independent evaluations because ratings may lag behind rapidly changing business conditions. Market-based indicators such as bond yield spreads and credit default swap spreads can also provide insights into investor perceptions of credit risk. Combining ratings analysis with detailed financial and qualitative assessment improves the accuracy and depth of corporate credit evaluation. Topic ultimately demonstrates that effective corporate credit analysis requires integrating financial metrics, business fundamentals, industry conditions, and capital structure considerations. Analysts assess profitability, leverage, liquidity, cash flow stability, and recovery prospects to determine an issuer's ability to meet debt obligations. Qualitative factors such as management quality and competitive positioning further influence long-term creditworthiness. By understanding these drivers of corporate credit risk, investors can evaluate bond pricing, estimate expected losses, and construct portfolios aligned with risk-return objectives. Mastery of corporate credit analysis is therefore essential for fixed-income investing, portfolio management, and broader financial decision-making within global capital markets.